Joining us now is Michael Sayers, Rockland Trust Vice President and Portfolio Manager. Michael, thank you for being here. You say, Michael, there's a combination of three things that need to happen if we're going to avoid a recession. What are they, Michael? Walk us through them.
Sure, absolutely, Josh, and thanks for having me. Well, even though the economy, I think, has some decent momentum, coming into the second quarter here, we know there is going to be, a lagged effect, a slowdown here from the lack of trade that's been happening with China and our other trading partners. So I think what we need to see over the next couple of months is, certainly some trade deals. The market got excited yesterday when we saw the agreement with the UK. Personally, I was a little bit underwhelmed by the result there. But of course, the big one is going to be China tomorrow, whether we can make some progress on the tariffs there, bring those down from that 145%. So we're going to need deals with a lot of the big trading partners over the next couple of months. Lower interest rates will help. Obviously, the Fed did not lower rates this week. We'll have another chance in June to see if they do that. And finally, we need to see progress on the tax bill, which is currently working its way through Congress.
What do you think is the likelihood, Michael, of each of those three items?
Well, I don't know if we need to get all three, but I think we're certainly going to see deals. I think the question is the market, are the deals going to be good enough for the market? So getting back to what I said earlier about the deal with the UK, the UK was in the best position to negotiate tariffs lower than 10% out of any of our trading partners, and even they got stuck at 10%. So that concerns me a little bit that all our other trading partners are going to be above 10% and maybe significantly above. So we're going to need to see better deals than the one that we got with the UK. I think lower rates is probably the least likely. I think given the Fed's concern around the tariff impact on driving up, prices and inflation, they could easily hold again in June. And then the tax bill, it's a wild card. I don't have a great read on that. We'll have to see what comes out over the next few weeks.
Michael, let's get to some picks here. I'm interested where you see opportunity. One is ticker ECL. Walk us through why that's a buy, Michael.
Sure. So that is Ecolab. So it's the leader in essentially cleaning and sanitizing products and services. They also are doing a lot more in pest control. So they've got a very diverse end markets in terms of the types of businesses that they sell into. So that makes for a very stable revenue profile. They've got strong pricing power. They actually announced a 5% trade surcharge to offset the negative impact from tariffs that they expect to see. And there's unlikely to be any effect on volumes for that because the switching costs are so high for customers. They've also got some cost efficiency and productivity programs. So we expect to see more margin increases there. And ultimately, we think this is a company that can do double-digit earnings growth over the long run.
Michael, how about NextEra Energy, right? We had seen sort of last year a lot of the various utility type companies, power generators do well on the back of the AI data center trade, but then a lot of them, including NextEra, have sort of come back down quite a bit.
Sure. So NextEra, it's a little bit of a contrarian call for us here. So one of the biggest utilities in the U.S., we think they have an advantage relative to their peers in terms of the supply chain. They actually just signed a new contract with a domestic battery supplier, so that will help them offset some tariffs in the near term. Ultimately, we're cautiously optimistic that there won't be a full repeal of the renewables tax credits and the Inflation Reduction Act that Congress is currently looking at. So, despite some potential headwinds that might be out there, we think this is a company that can grow earnings 6 to 8% over the long term. That's about as good as it gets for utilities.
Final pick here, Schwab. Walk us through that one, Michael. Why do you see opportunity in that name?
Sure. So Charles Schwab, giant broker, about $10 trillion of assets under management. We think they benefit in the near term, actually, because of the volatility in the markets. When this happens, investors tend to trade a little bit more, and or seek professional advice from advisors at Schwab, and that certainly showed up in their first quarter results, which were stronger than expected. And then longer term, we think they've gotten to the point where they're past most of the customer attrition issues from the TD Ameritrade acquisition a few years ago. and now they're in a better position to return to mid-single-digit net new assets growth, and that's going to help them do mid-teens earnings growth over the next few years.
Michael, thanks for bringing us some picks. Appreciate it.
You're welcome. Thanks for having me.